Section 13.2 is a brand new concept for us. We're going to take a look at how do we calculate and record employer payroll taxes. 13.1 we just went through and journalized and recorded what it cost us to pay employees, but there are additional costs that go with it, and that is our employer taxes. Employers must pay to the government the taxes withheld from the employee earnings. 3 green has withheld federal income tax, Social Security, and Medicare tax from employees' wages and salaries. The amounts withheld are liabilities to the business until they're actually paid to the government. In addition, employers must pay several of their own payroll taxes. Employer payroll taxes are business expenses and are recorded in the payroll tax expense account. Most employers must pay 4 separate payroll taxes. These 4 taxes that you must know are Social Security, Medicare, federal unemployment, and state unemployment. Social Security and Medicare taxes are the only payroll taxes paid both by the employees and the employers. 3 green withheld $577 in Social Security tax and $117.11 in Medicare tax from the employee wages for the pay period ended December 15th. The business owes the same amount of Social Security and Medicare taxes as withheld from the employees. 3 green Social Security and Medicare taxes for the pay period ended December 15th are also $500.77 and $117.11 respectively. Congress sets the Social Security and Medicare tax rates for employees and employers. Congress often changes the tax rates and the tax base. The Social Security tax rate used in our book is 6.2% of their earnings up to the tax base of a maximum of $106,800 each calendar year. Medicare does not have a tax base, therefore Medicare tax is calculated on the total employee's earnings. Medicare tax rate in this text is 1.45% of total employee earnings. Remember, Social Security tax and Medicare tax are the only payroll taxes both the employer and the employee. A business pays the same amount of Social Security tax and Medicare tax as the amount withheld from the employees. Federal unemployment tax, FUTA, is created a nationwide program to provide cash payments to employees who lose their jobs through no fault of their own. Federal unemployment insurance laws require that employers pay taxes to fund unemployment benefits. These taxes are used to pay worker benefits for limited periods of unemployment and to administer the employment benefit program. A federal tax paid by employers to administer this unemployment program is called federal unemployment tax, commonly referred to as FUTA. The tax rate and the tax base for FUTA taxes are referred to in the FUTA tax rate and FUTA tax base. State unemployment taxes are paid by unemployment programs. A state tax paid by employers that is often used to pay benefits to unemployed workers is called state unemployment tax, also referred to as SUTA. The Social Security Administration specifies certain standards for unemployment benefits law. Therefore, state unemployment laws differ very little. However, each employer must know the requirements of the state in which it operates. The tax rate for SUTA taxes is referred to as the SUTA tax rate, and the SUTA tax uses the FUTA tax base. Remember, employers must pay 4 taxes on employee earnings: Social Security, Medicare, FUTA, and SUTA tax. The FUTA tax rate is 6.2% of the FUTA tax base. Currently, the first $7,000 earned by each employee, earnings subject to unemployment taxes are referred to as the FUTA earnings. Employers can generally deduct from federal unemployment payments the amount they pay to state unemployment programs, but the deduction cannot be more than 5.4% of FUTA earnings. The effective FUTA tax rate in most states, therefore, is 0.8% on the first $7,000 earned by each employee. So when we go through and take a look at this, we're going to see that the first step is from each employee's earning records, we have to enter the total earnings prior to the current pay period. John P. Butler's prior earnings as of November 30th was $27,195, and they are recorded in the first column. Next, we're going to enter the amount of earnings needed for each employee to reach the $7,000 FUTA tax base. Subtract the prior earnings, column 2, from $7,000. Enter 0 if the amount is less than 0. Mr. Butler's amount, $7,000 minus $27,195, is a negative. Therefore, we're going to enter 0. But when we take a look at Anthony, Anthony has $1,740 that are going to be earned for a FUTA tax base. The third step is going to be to enter the current pay period earnings in 4. Mr. Butler's earnings for December 15th pay period is $1,466.25. And we're going to enter in column 5 the lesser of the amounts in column 3 and 4, and then total column 5. If the earnings from the current pay period, column 4, are less than or equal to the earnings needed to reach the FUTA tax base, then all current earnings are FUTA earnings. We'll enter the earnings amount in column 5. Anthony R. Fang and Ann Lindsay have earned earnings that match this test. If the earnings for the current pay period are greater than the amount in column 3, then FUTA earnings are the amount of column 3. For Carly, the earnings for the current pay period is $1,444, and it's greater than the $510 of the earnings needed to reach the $7,000 FUTA tax base. Therefore, only $510 is entered in for Miss Wells' FUTA earnings. The total FUTA earnings column, this total amount, $2,244, is used to calculate our unemployment taxes. Don't forget, earnings are subject to the FUTA taxes until an employee's accumulated earnings have reached the FUTA tax base. In our book is going to be $7,000. Employer taxes are going to be paid to the government at later dates than what they are journalized. However, the liabilities are incurred when the salaries are paid. Therefore, the transaction to record employer taxes expense is journalized on the same date as the payroll is journalized. The salary expense and the employer payroll taxes expense are both recorded in the same accounting pay period. So our transaction is listed on the left, and here we have our T accounts listed on the right. You will notice that our source document is a memorandum, so therefore it must be journalized in our general journal. To put it into our general journal, the first step is going to put the date of the 15th in the date column. We're going to write the title of the expense account debited, payroll taxes expense, in our title column. We're going to write our memorandum M44 in our document column. Then we're going to go for step 4. We're going to enter our debit amount of $757.01. We'll write number 5 is going to put in our accounts credited. So we have to list each one of our liability accounts: Social Security tax payable, Medicare tax payable, unemployment tax payable, and unemployment tax payable state on our next 4 lines indicated where they get indented. After that, we have to put in the amounts that are going to be credited. All of this information, again, is going to be listed right within that journalizing transaction. But it is very important that you know how to calculate those 4 employer taxes. Remember, whatever the employees pay in Social Security, the employer will also pay. Medicare is also. We have 2 matching taxes, and then there are 2 taxes that the employer pays that the employees do not, and that's going to be your federal and state unemployment. So that's taking a look at section 13.2. I do highly recommend that you join the online learning platform when we go through to do the work together. It's going to be kind of complicated to calculate which ones you pay taxes on. I look forward to seeing you then.